Production. He is Chief Executive Officer of Roubini Macro Associates, Professor of Economics at the Stern School of Business in New York and New York University, and he's been a friend of Chernobyl. We're not in Chernobyl, but it's like as if we were in Chernobyl for a very long time. So Nouriel, the floor is yours for 15 minutes.
Hi, everyone. Thanks very much, Carlo, for the kind introduction. It's great to be on this panel with a great group of other folks. I listen to them. So I want to talk about this COVID recession and what's the outlook for next year. So what happened in 2020? In 2020, we had the worst global synchronized recession since literally the Great Depression. And there was a collapse of economic activity in the first half of the year, in the first and the second quarter, because of course we had to shut down economic activity to stop the spread of the contagion. We had to flatten the curve, and therefore first China, then Europe, then US, then emerging market, they all went into a free fall. That's the bad news. The good news is that this ended up being the shortest also recession we've had in decades. It lasted approximately only 4 months between February and May, and then economic activity started to recover. Why it started to recover? For two reasons. First of all, we reopened economic activity once the curve started to flatten. Some people say, and I'll discuss it, we reopened too fast, too soon. And secondly, it was massive front-loaded macroeconomic stimulus, a massive monetary stimulus, massive fiscal stimulus, and massive credit easing to try to help individuals and firms that were illiquid but solvent. So massive unconventional monetary, fiscal, and credit policies. Now, what was the shape of this recession recovery? In the first half of the year, it was like an eye, literally a free fall of economic activity. Output, employment, demand, everything was collapsing given the shutdown. So that was Q1 and Q2. Then in the third quarter, we started to see what people thought was a V-shaped recovery, but it's easy to grow very fast, say 33% annualized rate in the US after output has collapsed for 2 quarters, and 33% annualized within the quarter is only 7%. So annualized numbers look better than they are. But what's happening right now, and that's my concern, is that this V-shaped recovery in the third quarter is already becoming either a U, anemic, subpar, below trend, or even a W, a double-dip recession, especially in the case of Europe. Why do I say that? There has been a recent significant spread of the contagion, and that significantly worsens the short-run growth economic outlook. The number of COVID cases are spiking in Europe, the United States, and most emerging markets, with the exception of emerging Asia and Japan. In the case of Europe, the second wave is leading already to renewed sharp lockdowns and to a serious risk of a double-dip W recession. I do expect that growth is going to be negative in the fourth quarter of this year in the Eurozone at the annualized rate of at least minus 10%, and it's going to be also negative in the first quarter of next year at the annualized rate of at least 4%. We'll also have negative growth rates in the United Kingdom, as well in Central and Eastern Europe that are linked to Germany and the rest of the Eurozone. So literally, we're going back to a double-dip recession in all of Europe. That's a fact based on the data. And I think that even the ECB is going to recognize it in December when they have the meeting of their own council and they have to provide new forecast about what growth is going to be. In the United States, the growth dynamic is slightly better than in Europe, but given the spike in COVID cases, the fourth quarter will show a massive growth slowdown relative to Q3. In Q3, we had 33% growth annualized. We'll be lucky if in the fourth quarter we have 2% growth annualized. That means pretty much close to zero. And that's as a forecast based on the assumption that we're not going to have any fiscal stimulus in the fourth quarter. The first quarter of next year could also be less than 2% and closer to zero if the fiscal stimulus is too small and passed during the lame duck session, or if it's passed late in the first quarter of next year, only after Biden is sworn into power after January 20. There are already many red flags. October retail sales in the US have shown a massive slowdown, much less than expected, 0.3 growth, the worst we've had in 6 months. The core group was even worse, plus 0.1. There has been a significant increase in initial claims for unemployment benefits, first times in weeks. And now there is this spat between the Fed and the Treasury on a bunch of credit line. The Fed is telling Treasury that we need them, and the Treasury, for political reason, just to spite the incoming Biden administration, wants to have these credit facilities shut down. That's the worst thing that could happen to the economy. So I would say that in the US, for Q4 and Q1, it will be at best close to zero, and there is even a risk of a W even in the United States if you don't pass a fiscal stimulus during the lame duck session of Congress, November, December, fast enough. Now, the debate about the trade-off between lives and livelihoods is misleading. People say, if you want to save lives, you have sharp shutdowns of economic activity and you destroy livelihoods. And if you instead you want to help livelihoods, you reopen and then there are more people dead. I think there's a false dichotomy for two reasons. Reason number one, if you do not control the spread of the virus, you need to go back to sharp lockdowns like it's happening right now in Europe. That leads to repeated stop, go policies and the W. That's what's happening in Europe right now. We have now the second wave occurring because they reopened too soon. Now they're going back into lockdown, and we're going to have a double-dip recession in Q4. But even in the United States, where the political appetite for new sharp lockdowns is low, the endogenous reaction of the private sector to a spike in cases, given the rise in uncertainty and risk aversion, can be one of less spending, less consumption, less capital spending, less employment, and more saving. So you get an economic slowdown even if you're not going back to draconian lockdown, because people become nervous, risk averse, spend less in the private sector, household and corporates, and therefore the economy slows down again. That's exactly what's happening in the United States. Now, the announcement of a vaccine is a positive for the market, but its economic effect will be positive only when it's widely distributed, and therefore people can return to currently risky activities like indoor dining, entertainment, sports, leisure, business, and tourism travel via airplanes. So there is a gap between the time when forward-looking markets move and when the real economy is going to turn around. The other point I think I want to make is very important, because people are very optimistic that once there is a vaccine, there'll be a boom economic activity next year. I'm skeptical for the following reason. The official claim is that the vaccine is going to be effective 90%. That's the headline. But I had a chance to speak with more than one scientist who told me that's total nonsense. Even the flu vaccine that has been around for decades is at best effective between 40 to 60%. And these scientists are telling me that the first batch of these new vaccines, whether Pfizer or Moderna, is going to be at best 30 or 40% effective, not 90, not even 50. So the risk is that we think that it is effective, we take it, we think we're immunized, we start to travel, we start to do indoor activities, and then we get sick again, and then things are going to get worse. So there is a lot of PR, there is a lot of political pressure to introduce the vaccines too soon. Those numbers are a fudge, are a total fudge. Additionally, we know there is a risk of permanent scarring and damage occurring to the economy. If there is a double-dip recession in Europe and US, or even the V-shaped recovery turns into a U-shaped one, we're going to have more permanent job losses, more business bankruptcies, less production, less employment, less capex on a more permanent basis. We're going to certainly see deleveraging by the corporate sector that has to continue given the high leverage of the corporate sector. I fully agree with Richard Koo. You need balance sheet repair for both corporates and households, and that implies, like after the global financial crisis, at best a U-shaped recovery, not a V-shaped recovery. So this deleveraging implies less capital spending, less employment, less production growth. A U-shaped recovery rather than a V, exactly like it happened after the global financial crisis. There is also risk of hysteresis effects in the labor market as folks that are unemployed for too long become unemployable, either because of stigma or because they lose their human capital learning by working and doing. Millions have already left the labor force in the United States. That's why the official unemployment rate has fallen a lot. But if you're looking at the U6 definition of unemployment, the one that includes discouraged workers and partially employed workers who would like to work full time, the number is not 7%, it's 12%. It's awful. And even in the Eurozone, there is now a risk that those short-term work programs are going to be phased out, and therefore there's going to be a significant pickup of the unemployment rate as the Eurozone enters a double-dip recession this quarter. There is also a significant risk of rise in bankruptcies in Europe that will lead to an increase in non-performing loans, something that now the ECB is getting worried about because it's going to lead to a credit crunch. And now there is even a risk that the Resilience and Recovery Fund is not going to be approved in time because of the political opposition of Hungary and Poland, and that's becoming another downside risk for the Eurozone. In emerging markets, things are even worse. For many emerging markets and poor countries, this is not a recession. This is what the World Bank has called a pandemic depression. 100 million people are at risk of falling back into extreme poverty with an income below $2 per day. It's a total disaster for many very poor countries in Africa and other parts of the world. And next year, globally, we're going to have a fiscal drag of about 2% of GDP, as we're not going to have the repeat of the large fiscal stimulus of 2020. This is exactly what happened after the global financial crisis, a fiscal drag in 2010, after the stimulus in 2008 and 9, that made the recovery anemic more like a U. And today in the US, I agree with David Wu, the US election risks are not completely gone. Trump is going to do anything to try to stay in power. Markets believe that the probability of something highly contested is low. I would not be surprised if things get ugly in the case of the United States. So that's a risk. At best, in the US, we're going to have divided government unless the two Georgia runoffs lead to a surprise win by the two Democrats. I think that's not likely. And that's going to imply that the fiscal stimulus is going to be not as much as is necessary in the United States, given the significant slowdown of growth. Now, the market are cheering because divided government for them means that Biden is not going to be able to raise taxes on corporates, on the wealthy, on capital gains. So the markets are cheering, but the lower fiscal stimulus is going to be much smaller than is needed, is going to be bad for the economy. So the economy is weakening because the pandemic is spreading like wildfire. There is no fiscal stimulus yet, and now you have even a fight between Treasury and the Fed on important credit easing facilities that are needed to make sure that illiquid but solvent agents are not going bankrupt. Now, the Fed, of course, will need to do more of the heavy lifting for growth if the fiscal policy does less, and that's going to have important implications for bond yields and the dollar. Now, one important question is whether the macro policy stimulus, monetary fiscal easing, is going to lead to prevent deflation or lowflation, or whether it's going to eventually cause inflation. Now, in the short run, of course, the risks are of lowflation, given that we have a slack in goods markets, labor markets, commodity markets, and real estate markets. And instead, the liquidity is going into asset reflation, if not asset inflation, given that we have zero policy rates, negative in Europe, and we have near zero long rates in the US, negative in Europe and in Japan. However, over the medium term, monetization of fiscal deficit, because we're effectively doing MMT policies or helicopter drop of money policies, this in the medium term, not this year next, but by 2022-33, could lead to higher inflation or stagflation, especially if negative supply shocks like deglobalization and a decoupling between US and China become more severe. Compared to what happened in the 70s when you had two negative oil shocks, 73 and 79, stagflationary shock, easy money, easy fiscal, we ended up with high inflation. So I would say that the main concern I have medium term is deglobalization, protectionism, fragmentation of the global economy, balkanization of global supply chains, and so on. and two, a decoupling between US and China in trade, in technology, in data, in information, in goods, in services. Even with Biden, this Cold War between US and China is not going to stop because there are much more deep forces that are leading to the conflict between US and China. The other concern about inflation is as follows. We have very high debt ratios right now in the global economy. The IIF has estimated just the other day that global debt that last year was already 320% of GDP between private and public sector, this year is going to go from 320 to 365% of GDP. And by next year, the number is going to be closer to 380. So how you reduce these high debt ratios? Many emerging markets that borrow in foreign currency are insolvent, they're going to go bankrupt. But in advanced economies where we can monetize fiscal deficits, eventually inflation, unexpected inflation, might be the solution to debt ratios that become eventually unsustainable. So I do worry that these policies of modern monetary theory imply effectively fiscal dominance rather than independence of the central bank and monetary dominance. We're going to go to a world where once the debt ratios are too high, the only option is going to be to keep rates lower for longer, to do QE longer for longer, and eventually inflation is going to rear its ugly head back again. So that's another risk to keep in mind, not for this year or next year, but inflation or stagflation may come back in the medium term. I will stop here with my remarks. Thank you.
Nouriel, thank you very much. I woke up this morning in a relatively good mood after this presentation. I think and actually this morning when I spoke, I said that there is still the hope that once a vaccine has been found, there may be a fast rebound, but it's true. If what you said is true about the vaccine, then I definitely start being more worried. But let's go ahead. The next speaker is Heiner Flassbeck. Heiner is a professor at the University of Hamburg,